Hi, Adam Gower here, and today you are in for a treat. It is not often that you hear from somebody who has built their real estate portfolio from 13 million to over $1 billion in under 10 years, and that is exactly what you're going to be hearing about from Max Sharkansky, founder and principal at Trion Properties. How he did it, what he did, what the secrets are. You're going to learn everything today. It's an amazing episode. To find out more about Max and Trion Properties, go to the podcast page at GowerCrowd.com. And while you're there, do please be sure to click on the news link in the menu at the very top of the page. We have the only news channel that is exclusively dedicated to real estate crowdfunding, where you will find a mass of information that you can immediately use, from news to education to access to every crowdfunded real estate deal on the market. All there at GowerCrowd.com. Subscribe after clicking the news tab on the top menu. All right, 13 million to 1 billion. How did he do it? What are his secrets? Here he is, Max Sharkansky, founder and principal at Trion Properties. Max, it's just such a huge pleasure to see you again now that you have fled the state. I have only one question for you. To start with, of course, one question to start with. Apart, of course, from the crowdfunding platform we built for you, what was the secret to your getting from $13 million to $1 billion in assets in just 10 years? Amazing story. I want to know the secret.
Brick by brick, I wish I could tell you a secret. I wish there was one magic bullet. There really isn't. It's just constant hard work, thinking outside the box. We spent a lot of time and money raising capital, just like we spent a lot of time and money meeting with brokers and finding deals and operations. And we, just like building any business, you kind of got to build every department one piece at a time. So, we had the acquisitions. That was the acquisitions piece is, I guess that always comes first because that was my background, right? So we had acquisitions naturally, but then you got to figure out raising capital, and that's breakfast, lunch, and dinner for sure with investors. In 2011, I believe it was, the Jobs Act came along, which was huge for our business. And we got in very, very early, and we started to raise capital online, and we got a lot of investors online. And we have gone to a lot of conferences. We've done everything possible to get our name out and to raise as much capital as possible. We could never have grown the portfolio to the size that we did today without spending that much time, money, and effort raising capital.
So you and I have known each other for actually a very long time now. It's the years just keep piling on. But when we were talking about crowdfunding the very, very first time, I don't know, 5 years ago or so, the conversation was that you were thinking of looking at institutional capital. And I asked, why not consider like doing your own crowdfunding? Tell me about that experience and what that's looked like for you as a private equity shop in terms of the capital formation you have. Instead of having big single checks, now you've got hundreds and hundreds of individual investors.
Well, just to clarify, we do both. So we have a lot of investors. We did buy last year a 9-figure deal. We bought a deal with $108 million purchase price, $118 million capitalization, and a $32 million equity check, which we syndicated. So that deal alone, I believe, was roughly 400 investors in a single deal. I know that sounds like a lot, and it is. The joke I made with my partner, Mitch, is I said, this isn't a syndication, this is an IPO, because it was such an effort by everybody. But we got it done, and we got the deal syndicated. But that said, we do.
Max, I've lost you. Oh my goodness. Oh, Max. Oh no. Max, what happened? Oh my goodness, what happened? I hope it's not me.
At least 2x in addition to what it's increasing organically. we have to have those relationships. It's very, very important. So, maybe over time we'll start to do less of those. I don't know that we will. I don't know that we won't. But right now we have 1,000 investors. At some point, if we have 3,000, 4,000, 5,000 investors, will we do as many joint ventures? Maybe not. But as it stands right now, we do both.
You actually cut out for a few minutes. Just tell me about the JV. This was the Disney product, was it?
Oh my gosh, I cut out?
Yeah, you did. Yeah, I was like waving like mad, and you cut out. I'm not sure. I was checking like frantically if it was my end. So I missed. You were just talking about the $100 million deal that you put together.
Oh my gosh. So what I was saying was, we bought a deal for $108 million with $118 million capitalization and a $32 million equity check. So that equity we syndicated as opposed to doing institutional and doing it in the JV format. We did it with 300 plus investors. There was actually closer to 400 investors. And I was joking with my partner that that's less of a syndication. It's more of an IPO at that point because there's so many investors. But we got it done. That said, we can't do that sequentially because we're doing a lot of deals. We're doing 10 plus deals a year. Last year, we did about $500 million. And we can't, even though we have 1,000 active investors right now, we can't go back to them once every 2-3 weeks for a new syndication. So we still do a lot of JVs. We have great relationships with some phenomenal partners, and we'll continue that for the next few years. At some point, will we have 3,000, 4,000, 5,000 investors? Yes, that's possible. And at that point, will we do less institutional joint ventures? Probably. But for now, we've got our 1,000 investors and continuing to do $500 million plus annually. And we'll do them in both formats of a syndication and a joint venture.
So it's interesting that you say that. With 1,000 investors, one of the biggest concerns that sponsors have when they first get into crowdfunding is how to handle so many investors. Instead of having to just talk to 1 or 2 institutional investors, you've got hundreds of. What's been your experience of that?
I mean, it's very simple. You just have to hire people. A sponsor is not a person. A sponsor is an organization, right? So you have to grow the organization. If you've read any books by Jim Collins, he talks about your growth ends when you stop your hiring. So you have to just continue to hire and continue to grow the business. Andrew Lucas very well. Andrew has been with us for many, many years now, and he's our director of capital markets, and he oversees all of our IR. He now has an associate because we've grown the business to a scale where he needs some help. So he could continue to do what he does best and bring in more investors into the business. And we have the software set up. We use Juniper Square, and they're phenomenal. And you keep playing that game. You just keep snowballing with more people, more software, more technology, and that's how you grow any business.
Let's change pace a little bit. Just recently, you fled the Golden State for the Sunshine State.
Right.
Why? Was there not enough gold in California? Tell me, what's the story behind that?
The gold was being taxed at 13%. No, I'm just kidding. I'm kidding. I actually did not go for tax purposes. That wasn't even in the top 5 reasons. It really was strictly business. In the beginning, it was strictly business. My partner and I walked into Mitch's office in the summer of 2020 when there was just a lot of pandemonium happening. And I said, we both just discussed that we got to diversify out of California. If you look at what happened in New York with the draconian vacancy control law that they passed, a lot of people got wiped out. I mean, their equity got wiped out because properties went down by 25 to 40%, which in the capital stack is equity. And at that point, you're getting into the debt. Some properties went bankrupt, went to foreclosure. And the short answer is we want to avoid that, right? We want to diversify away from deep blue policies. So we started looking at other parts of the country, and we felt that the Southeast would have a tremendous amount of growth. Florida, Georgia, the Carolinas. I mean, if you look at the migration patterns in the country, a lot of Americans are going into those states. So we decided, A, we want to diversify out. B, we want to continue to grow the business and go into regions that are growing. So We decided to open an office in Miami. I volunteered to move here and to grow out the team and grow out the portfolio. And I think we made a good decision in retrospect. We opened the office in June of 2021. It took almost a year to actually make the move because my kids had to finish their school year. But we did hire somebody. We started the hiring process December of 2020. We hired a director of acquisitions who started February, March 2021. He hit the ground running. I moved here in June. We bought our first deal in May, June. We put under contract in May, June. We closed in September. Then we bought it. That was in Fayetteville, North Carolina. Then we bought a deal in Orlando. Then we bought a deal in Charleston. So last year we wound up doing about a couple $100 million, maybe a little bit more, out of an office that was 9 months old. So not even. I mean, the office, I was here for 6 months. He was working remote for 9. And the LA office wound up doing $300 million. So we wound up having a great year and just fantastic move. And now we've got some more properties here in the Southeast in the pipeline. Same with LA. So there's just a lot of good stuff going on.
So I hear stories of rents in Florida, apartment rents going up 1-2% a month. So what are you seeing actually on the ground in the Southeast, and compare it with California?
So you're right. Rents are going up about 1-2% a month. It's just unbelievable. I've never, with my own 2 eyes, seen this kind of growth. The top 3 rent growth markets in the country are Tampa, Miami, and Orlando. And those 3 markets have something in common. They're in Florida. Outside of Florida, I believe it's Charleston, which is also in the Southeast, where we also now own. Just an unbelievable amount of people migrating from the Northeast and the upper Midwest into the Southeast. What also migrates when you have people, actually, it's more of a chicken and the egg thing, is businesses. It's a very business friendly part of the country. Businesses come here. Disney, as we know, as an example, one of their big departments left California and moved to Orlando. It was about 2,000 employees. Microsoft signed a lease in Miami for 50,000 square feet. A lot of the big venture capitalists have open offices in Miami. Starwood left Connecticut, and their main headquarters now is in Miami. I mean, the list goes on and on. I can spend hours talking to you about this. And all of those fundamentals have created one of the best rent growth environments in American history. It truly is unbelievable what has happened with rents and single family housing prices. It's just astronomical. And then in terms of the Golden State, California, how that compares, LA and San Francisco are very, very sluggish. There are some, a lot of what you see in the news and what you read in the headlines is the exodus of California, but there's a lot of movement within California as well that people aren't really talking about, but it's very real and very much happening. So a lot of people are leaving LA and San Francisco. San Franciscans and generally, or I should say Bay Area people are going to Sacramento. And we are seeing the same type of growth there, almost neck and neck, that we're seeing in the Southeast. I mean, like 1% a month plus in Sacramento, 2% vacancy rates, just unbelievable growth. And people who are leaving LA are going to the Inland Empire, San Diego, and Orange County. San Diego and Orange County are on fire. Same type of 1-2% monthly growth. But the tougher parts of California are LA and San Francisco. We own a lot in the Bay. I mean, we own, I don't know, maybe close to 1,000 units in the Bay, 700-800 units in the Bay, and the growth just isn't there.
Is not there in terms of rent.
I mean, it's pockety. It's pockety. Not like parts of the country that you read about in the news. Not like what we're discussing.
So these rent growth trends are extraordinary, right? And they're unprecedented. And of course, I'm going to read you the Reuters. My favorite news channel is Reuters. I don't know if I'm not confessing anything political. I hope it's not. But I like to read Reuters. And the headline right now is US consumer prices post biggest rise in nearly 40 years. Inflation close to peaking. So what is your view of inflation? What's going on, and what should investors be thinking about?
Well, I took Econ 101 when I was in college, when I was about 19 years old. And chapter one, page one, day one was if you print $6 trillion, you're going to have an inflationary environment. So I don't think there's anything outside the box that you have to be incredibly intelligent to have figured this out. Barry Sternlicht and Sam Zell, this is not like you need guys of this IQ to figure something like this out. So yes, clearly this was going to happen. We've printed an incredible amount of money. We are continuing to print money. We are still continuing to collect ERAP money. That's Emergency Rental Assistance Program, because people don't need to pay rent. The government feels, in some of these states, the government feels that they don't need to pay rent, and hardships aren't very difficult to prove. You don't need to be unemployed. We just had a call with our operations team in Colorado to discuss what they're doing in Colorado. And I asked them what the details are of the application. And as long as you meet a certain income test, a certain level of income, I think it's 80% AMI or 100% AMI, they'll give you free rent. So the government is continuing to print money. It's increasing the money supply. I think working class Americans are going to get a shot in the arm with this stuff, with the free rent and the stimulus. And then it's just going to trickle up. Unfortunately, people are just going to get decimated with this inflation. You've got 20% rent growth, you've got 7% CPI, and the 7% CPI probably doesn't really tell the whole story. So you can give raises of 5-6% a year. If somebody gets a 5% raise, they just took a 2% pay cut, because CPI is 7%. So if your salary goes up by 5, but all of your food, housing, travel costs go up by 7, that's not good news. So I don't know, man. It's a tough environment. You've got low unemployment, very, very high inflation. They're going to continue to see rent growth. How some of the deep blue states respond, how some of the deep blue cities respond, I don't know, because we know how they responded in the past, and it's non-favorable. So we'll see.
Page 2 of that book on Economics 101 talked about interest rates, right?
Mm-hmm,
and
sure.
if inflation is going up, there's intense pressure on interest rates to go up. That's certainly something that's been talked about. That's a major component of real estate investing. Talk to me about the inevitability of interest rates and what you guys are doing to hedge that and to prepare for the inevitability.
Sure. So micro in our portfolio, we have a lot of floating rate debt, but we buy a lot of interest caps and swaps. So we use derivatives to hedge our interest rate exposure. Going more macro, I think if you look at it historically, especially over the last few cycles, these things don't rise and fall basis point for basis point. So what I mean by that is you'll see the Fed raise interest rates over the next year, probably 3 or 4 times, the next year, probably 2 or 3 times. So, we're looking at 100 to 150 basis points of interest rate increases over the next 2 years. That said, you'll probably see cost of debt increase 75 basis points or so, maybe 100 basis points, 75 to 100, let's say. And cap rates will not increase with that. And I say that because what happens when interest rates go up, spreads usually come in. Lenders understand that you can't just go up basis point for basis point, you'll kill the market. So spreads usually come in. And then cap rates, of course, will not go up basis point for basis point. You'll have people just stomach lower IRRs, they'll stomach lower cash on cash returns. So that's what we think is going to happen. And again, that's just a function of how much interest rates ultimately go up and how bad inflation gets.
Look, you and I got to know each other during the last downturn, 2007, right? When we first met and first started talking. And one of your mantras, if that's not the right word, but debt is the killer, right? And that's what we saw killing so many deals during that downturn. Too much debt. You talk about a 100 basis point increase to interest rates, but when you have interest rates at 3%, 100 basis points is a 30% increase in debt. What are you anticipating the impact of this 100 basis point increase will be on you, on the opportunity for you to find deals from people that maybe haven't been as prudent in their underwriting as you have?
Well, I think if you look at it historically, especially the last few cycles, an interest rate increase probably won't tip us into a recession. If somebody's got a lot of floating rate debt in their portfolio and they rise by 100 basis points, I just don't think it's going to impact them that much, especially if you look at rent growth. Going back to the earlier part of this podcast where we're talking about rents going up 1 to 2% a month, of course, that's not sustainable, but even if they go up 3 to 5% annually, you're still going to outpace your 100 basis points of debt. And if someone's levered, even if they're levered as high as 75% portfolio wide, if you run that through a model, they'll be fine.
Now that you are getting so big, we kind of touched on this a little bit earlier, what is your plan for capital formation going forwards? Are you moving more towards institutional capital? I know you say you've got 1,000 investors, but you can't tap them every other month, right? For the next deal. So
every 3 weeks.
Every 3 weeks, right? So what is your strategy going forwards as far as capitalizing, financing your growth?
The strategy is to continue to build both. Both our database of high net worth accredited investors and our database of institutional equity partners. We've got some phenomenal relationships and some partners that are just phenomenal. We love working with them. And, in a perfect world, you just call them and they say yes. But a lot of the times they say no, more often than not, for whatever reason. And then you got to just keep calling, So we have to build our database of institutional equity partners until we don't, right? So once we've got 3,000, 4,000, 5,000 accredited investors, then we probably don't need to rely on that channel as much, but you never know. I mean, even if you look at publicly traded companies, you look at some of the big REITs, when their stock is down, they're not going to issue stock to raise cash. So they're doing JVs. The biggest publicly traded REITs will occasionally do JVs with some of the big institutional groups. So it really never ends.
Now, you did do some ground up. We talked about this before we started. You did do some ground up in California, but you still are resistant to ground up development, even where the demand is so incredibly strong as it is in Florida and outpacing supply. What is it you don't like about ground up development?
I really don't like having the local government as my partner because they are very much your partner. And if you want to go into development and think they're not your partner, you're kidding yourself, because you need them to help you with entitlements and you need them with inspections and you need them to come out and give you your certificate of occupancy. You need them every step of the way. And throughout COVID, they haven't been great. And they have a reputation in California for being very anti-development. And it's just, you got to ask yourself, why swim upstream, right? So it made a little more sense when the population in California was booming and you could play the game of the supply-demand imbalance. So once you go through the excruciating pain of building this building, you have something, you have gold, because it is so hard to develop and you're 99% occupied most of the time and rents are growing. But now with a lot of these markets, these major metropolitan markets in California being fairly stagnant, it's not worth the pain to go through that. I mean, we had some real problems in our last couple of developments where, for example, the Department of Water and Power doesn't show up. They don't come out for 6 months. So if you've got a vacant building sitting there waiting for somebody to come turn on the lights, that kills your return. That's it. Your project's dead. So I don't like being beholden to those factors.
Florida versus California. What surprises have you seen? I mean, in terms of not in terms of the political environment and blue versus red and that aspect, but in terms of the kinds of upgrades that you do, the demands that tenants have, the very nature of multifamily. Is there a substantial difference between, or any difference really, between the way that you operate or improve a building in Florida versus California?
I can't say that either one. Well, look, in California, you have a lot more regs to work around, right? So you have to know your regs. So you need a local operations team who's very, very good and knows their regs. In Florida, I would say, and in the Southeast, you want to know the right vendors, right? Because labor could be pretty spotty. So I would say that's the main difference. Like, you really want to be strong with your vendor relationship in the Southeast versus in California. You better know how to navigate those regs. Otherwise, you can end up in a huge lawsuit or worse.
Well, the kinds of things that I've heard about in Florida, for example, are that you just don't have in California: humidity and the impact of humidity to how you operate multifamily property. Sure. You got to have air conditioning on. You know, you don't want properties sitting empty, etc., because of the humidity and the implications that that can have on decay, etc. Are there any, apart from that, or is that something you've noticed, or are there any other surprises that you were not expecting when you headed east?
Well, keep in mind, so our LA office doesn't just cover California, it also covers Oregon and Colorado, right? Oregon's very wet, Colorado can be cold, Florida's humid. I would say, in terms of exposure to the elements, humidity is probably easier to manage than water and snow and hail. Colorado is one of the worst insurance markets in America because of climate change and the constant hailstorms. So an insurance broker told me not that long ago that insurance carriers, I believe it was in 2020, they told me this last year, in 2020, there was 100% loss rate. So every single property, everything had a claim because of the hailstorms.
Good grief.
So So, that's a tough market. The humidity, you paint a little more. Yes, you're going to have your HVACs are going to turn over more often. You have to paint the exterior of the building more often because the moisture, if you don't have fresh elastomeric paint, the moisture can get into the stucco, and that, of course, can cost you a lot more than just repainting the building. So again, these are things that a local operations team will have knowledge of and know how to manage. You just have to know how to manage it. You're going to have higher insurance costs because of the hurricanes. So you underwrite all these things and manage it.
And you're in Denver as well, aren't you? You went into Denver within the last, couple of years?
We entered Denver. We tried entering in 2019. Right. We finally bought our first deal in 2020. Then we bought some more in 2021. And we love Colorado. It's a fantastic market. And we're going to continue to buy there.
And that's because of the same economic drivers as you're seeing in Florida? You're seeing the same kind of growth?
Yes. Denver is still one of the most moved to cities from California. So you get a huge amount of growth, phenomenal economic drivers, great quality of life. You're near the mountains. You get 300 days of sun. Even though it can get cold, you get a lot of sunshine. It's just a great city.
Last question, and then I'm going to ask you 3 sign-off, quick, rapid-fire questions.
Sure.
How long is it going to take you? And, how long is it going to take you? How are you going to get there to the next billion? How long did it take you? Actually, so I read this article. I forget who it was. One of you guys posted it on LinkedIn. It's what inspired me to give you a call and ask you to come on the show. So when was that 13 million? Was that around the time you and I met? That must have been 2008 or later even than that?
It was something like that. Yeah. Well, we sold everything in 2009. So we aggregated a portfolio in 05, 06, 07. We sold it. We had fortunate timing. So we sold it prior to the crash. And you and I met because as we were selling, we started targeting non-performing debt.
Right.
And we were a little bit ahead of our time in 2008. And then in 2009, it finally crashed. And that's how you and I met, because you were selling notes at East West Bank.
Right.
So then we started to rebuild it. But back then it was just churn and burn. And then we really started to rebuild and build a real portfolio from 12, 13. So it took us about 8 years to do that. Okay. 7, 8 years to do that. And we did a lot of it the last few years. COVID in a way was a blessing to scaling that portfolio because we couldn't really sell into COVID. And
I
That
see.
just makes, yeah, that made us 100% net buyer almost. I mean, we sold a few properties along the way, but
Hmm.
nothing remotely close to what we usually sell. And
Hmm.
we bought significantly more. And we also bought in 2020 when a lot of people weren't buying, when they went pencils down, we continued to
Hmm.
buy. And then, of course, opening a new office and expanding helped us do that. But I'm hoping 2022 is another banner year. And hopefully we can get to 2 billion either in 2022 or shortly thereafter.
Oh my goodness, really? So what's the market for exits looking like now?
Oh, I mean, the market's phenomenal. The
Are,
market's
are you looking
phenomenal.
to divest? I mean, it must be just insane. It must be hard to resist, I would imagine.
Yes, we're selling a few, we're recapping a few. So, we're selling some small non-core assets that just don't fit in our portfolio anymore. We are recapitalizing a few assets that we love and we want to go long on because they have scale and they're in good markets. And then we're also selling a few in the East Bay, California that we just need to round trip. So yeah, we're doing a little bit of everything. We're selling, we're recapping, and we're buying a lot.
Let me ask you 3 sign-off questions. Now that you've moved to Florida, how have your key daily habits changed that make you successful and productive?
Oh
If they've
boy.
changed at all.
I think that some of the key habits are probably the same. I work out mornings before I go to work. I eat well, sound body, sound mind, right? Like if you don't take care of yourself first, then you can't really run a business or a family. You can't take care of anybody else unless you take care of yourself first. So that credo holds true. I just, obviously I don't go to the same gym and I'm finding different sources for food. And I'll tell you, I really do miss the produce in California. The fruits and vegetables in California are just unparalleled.
You're
With all due
kidding,
respect,
really?
yeah, there's an area in Miami called Homestead, which is the agricultural area. And a lot of the produce comes from there. And it's good, but there's nothing like California fruits and vegetables.
That's really interesting to know. I should be more appreciative of it, and from now on, I think. All
My
right.
wife loves shopping at Erewhon, and that is her one big miss from California. She's even considered calling them to see if she could franchise Erewhon
I was going to
or
say,
organic food into Miami.
really, that's really interesting. All right. So, what's been the hardest lesson you've learned on your climb to $1 billion?
What has been the hardest lesson? I would say one of the things we've learned, I would say the key, I don't know if I would say this is the hardest lesson, but I would say the key lesson, what we talked about earlier with regard to scale, is people. You got to have the right people. Making a bad hire is horrible. So make sure you're fine tuning your interview process and how you screen people and how you hire, and use headhunters when you can afford it, for young business people who are scaling. So that's one of the key problems you have to solve for, is hiring the right people.
And
You can't do it by yourself.
There's quite a shortage, isn't it? How many people do you have now on staff?
In
Not including
corporate,
in corporate, yeah.
in corporate, we're probably around 30.
Oh, you were about that when you were in LA, weren't you? When I first visited
Well,
you in.
plus the debt guys. We've got the debt guys in an affiliate company, so there are probably another 7 to 10 guys there. So probably closer to 40.
Okay.
No, I think when you and I were talking in LA, like when you would come to our office at the Pacific Design Center, we were closer to between 15 and 20.
Oh, okay.
So we've hired 5 in Miami, plus call it another 7, 8 in LA.
Got it. All right. Let me ask my last question. So, for an accredited investor who's not invested yet in real estate, who's interested in real estate, what advice do you give them? What advice would you give them if they are considering making the plunge into investing through a crowdfunded syndication like the kind that you put together?
I would check the quality of the sponsor. What is their track record? How many deals have they round tripped? How many deals have they bought? How many are in portfolio? I would check the underwriting, although that's a little trickier, right? Because for somebody who's not sophisticated in the industry, they're not going to really know what to look at. But you could look at some basic things like, what are their exit caps? Are they very aggressive? What are their rent growth rates? Are they very aggressive? I think if you actually just look at those two, you can get an idea of what the sponsor's philosophy is on underwriting. Mm-hmm. So if you've got a sponsor who's underwriting 8% rent growth and 3.5% exit caps, then you know you're probably dealing with somebody who's unrealistic. But if somebody's underwriting 4.5 to 5 cap exits, 3 to 5% rent growth, 3 to 4% rent growth, and if you look at the rent comps and it looks like they're in line, then you've got that's a responsible sponsor. So I would say that's number one, because you got to bet on the jockey. You're not going to bet on the horse.
Max Sharkansky, Trion Properties. It's always an enormous pleasure to see you. It's been far too long. Thank you so much for joining me today.
Thank you for having me on, Adam. Great to see you.
That was Max Sharkansky, founder and principal at Trion Properties. Be sure to go to GowerCrowd.com and hit the news link in the menu at the top of the page. We do have the only news channel that is exclusively dedicated to real estate crowdfunding, where you will find everything that you need to know about real estate investing, particularly through crowdfunded syndications. It's totally free. Get on my newsletter. You can always unsubscribe. All there at GowerCrowd.com. Thanks for joining me, Max. It's always an enormous pleasure to see you. Good luck in reaching your second billion, all being well, in 2022, an extraordinary objective. And thank you also for listening. I really appreciate the time that you spent with me today. That's all for today. Be well, stay safe, and for now, this is Adam Gower signing off.